You've got $11,800 sitting in a 401k from that job you left back in 2015. Life happened, you moved on, and honestly you forgot about it until you got that annual statement in the mail. Your first instinct, roll it over to an IRA. It sounds simple enough, the money's pre-tax, you move it within 60 days, and boom, it's in your new IRA tax-free. But here's where most people get blindsided: the IRS Pro-Rata rule. Over the next 9 minutes, I'm going to walk you through exactly how this rule works, show you the specific calculations that determine how much of that $11,800 becomes ordinary taxable income, and more importantly, show you what you can do about it. Let me start with a real scenario that plays out for thousands of Americans every single year. Meet Sarah, a 42-year-old marketing director who left her corporate job in 2015. She had a 401k with $11,800 in it, a mix of her contributions and employer matching. Fast forward to 2024, she's job hopping again, and her new employer's benefits team asks if she wants to roll over any old retirement accounts. Sarah thinks, why not? She's also been maxing out her own traditional IRA contributions since 2018, so she currently has $18,500 sitting in a non-employer IRA. She initiates a rollover of that $11,800 from her old 401k to a new IRA. Here's what Sarah didn't know. The moment she did this, the IRS Pro-Rata rule kicked in. The Pro-Rata rule is a calculation that treats all of your pre-tax IRAs and pre-tax employer plans as one big bucket for tax purposes. It doesn't matter if the $11,800 is technically coming from a 401k. The IRS looks at the total of all your pre-tax retirement accounts to determine how much of the rollover is taxable. Let's walk through Sarah's exact situation. Before the rollover, old 401k, $11,800 100% pre-tax, personal traditional IRA, $18,500 100% pre-tax, total pre-tax retirement accounts, $30,300. Now, when she rolls over that $11,800, the IRS asks, of all her pre-tax money, what percentage is non-deductible contributions? In Sarah's case, she made only deductible contributions, so 42% of her accounts are non-deductible. That means 100% of the $11,800 rollover is treated as taxable income. But wait, that's actually her best-case scenario. Let me show you a more complicated example that illustrates why this rule is so dangerous. Consider Mark, a 48-year-old consultant. Mark left his job in 2010 with a 401k containing $45,000. At the time, he rolled $30,000 to a traditional IRA, but he also had $15,000 in after-tax contributions that he couldn't roll over due to the rules back then. However, he did roll those after-tax contributions to a Roth IRA in 2012, what's called a backdoor Roth strategy. Later, in 2015, he made non-deductible contributions of $500 to his traditional IRA because his income exceeded the Roth contribution limits. Now it's 2024, and Mark wants to roll over his current 401k of $22,000. He thinks this is straightforward. But here's what Mark has: current 401k, $22,000, 100% pre-tax, personal traditional IRA, $35,000, $30,000 pre-tax from the original rollover, plus $5,000 from accumulated earnings on the non-deductible contributions. The $15,000 he rolled to Roth is separate and doesn't count non-deductible basis in his traditional IRA. $500 total pre-tax balance, $57,000 non-deductible contributions, $500 percentage of non-deductible money, $500/57,000 equals 9. 65% when Mark rolls over that $22,000 from his 401k, only 65% of it is considered non-taxable. The remaining 35% is taxable income. Taxable amount, $22,000 times 90. 35% equals $19,877. Mark was expecting a simple tax-free rollover. Instead, he's looking at nearly $20,000 in additional taxable income, which at his tax bracket could mean $5,000, $8,000 in actual taxes owed. Now here's a critical question many people ask: why is there a pro-rata rule at all? The answer comes from tax policy history. The IRS created this rule because of concerns about abuse. If the rule didn't exist, high-income earners could make non-deductible IRA contributions, then immediately roll those to a 401k if their employer allowed, creating a backdoor to convert large amounts to Roth IRAs. The Pro-Rata rule was designed to close this loophole by making it mathematically unattractive to mix pre-tax and after-tax money in IRAs. According to IRS publication 590B, which governs IRA distributions and rollovers, this rule has been in place since the Tax Reform Act of 1986. But here's a counterargument many financial advisors make: the rule is overly blunt. It punishes people for legitimate financial decisions, like rolling over old 401ks or making non-deductible contributions when income limits prevent Roth access. The rule doesn't distinguish between intentional mixing of accounts and accidental situations. So what can you actually do about this? There are several strategies, and each has pros and cons. Strategy 1, roll to your new employer's 401k. This is often the best solution, but it requires your new employer's plan to allow it. If your new 401k plan permits incoming rollovers, you can roll your old 401k directly into the new one. Here's the key. The pro-rata rule does not apply to assets already inside a 401k plan. Only IRAs are subject to it. By keeping the $11,800 inside a 401k, you avoid the entire problem. However, not all plans allow this. Some employer plans have restrictions, or they might not allow rollovers from other employers. You'd need to check your new employer's plan documents. Strategy 2, the aggregation loophole workaround if you have non-deductible contributions in a traditional IRA. Some financial advisors suggest exploring whether you can roll those non-deductible portions directly to a Roth IRA using what's sometimes called the pro-rata rule workaround. However, this gets complicated and depends on recent tax law changes. The IRS issued guidance in 2022 that allows pro-rata calculations to be done on a per-year basis for certain situations, but this doesn't fully eliminate the rule. Strategy 3, direct rollovers vs. 60-day rollovers. The 60-day window I mentioned creates another trap. If your old employer sends you a check for the $11,800 and you deposit it in your personal account for any reason, even for a day, you risk the IRS arguing that it's a taxable distribution. The safer approach is a direct trustee-to-trustee rollover, where the old 401k custodian sends the money directly to your new IRA without you touching it. This avoids the withholding rules and some timing issues, though it doesn't help with the pro-rata rule itself. Strategy 4, wait for employer changes. If you're currently employed and think you'll change jobs soon, some advisors suggest rolling your old 401k into your current employer's plan, if allowed, before you leave. Then, when you change jobs, you can roll everything into the new employer's 401k, bypassing the pro-rata rule issue entirely. Let's return to Sarah's example and see what her actual tax bill might look like. If that entire $11,800 rollover is treated as ordinary income, and Sarah is in the 24% federal tax bracket, that's $2,832 in federal taxes alone. Add state taxes, and she might owe $3,500 for $000 on money she thought was a tax-free rollover. For Mark, his $19,877 in additional taxable income could result in $4,771 in federal taxes at the 24% bracket, plus state taxes. That's a significant hit that completely changes the math on whether he should have rolled over the 401k at all. Here's what the IRS's official guidance says. According to publication 590B, if you have both deductible and non-deductible contributions to your traditional IRAs, you must use a formula to figure out how much of a distribution is tax-free. Calculation is non-deductible contributions as of DEC 31 of year of distribution divided by total value of all traditional IRAs as of DEC 31 of year of distribution equals non-taxable percentage. This percentage applies to the entire rollover, not just a portion. One final consideration, timing. If you're planning a rollover, doing it early in the year gives you time to recalculate and adjust if needed. Doing it late in the year, when you might owe taxes in April, compounds the problem. Also, if you're considering a backdoor Roth strategy, the pro-rata rule becomes an even bigger consideration. Many CPAs now recommend clients with existing IRA balances avoid the backdoor Roth entirely if they have pre-tax money in other accounts. In summary, that $11,800 401k rollover that seemed simple can easily turn into a $4,000 plus tax bill if you're not careful. The pro-rata rule is real, it's inflexible, and it affects more people than realize it. The best strategy is to check whether your new employer allows direct rollovers to their 401k. Calculate your exact pro-rata percentage.